Hey, I'm Mike, and I make money simple. Welcome back to Zero to Wealth, your blueprint for becoming a confident investor. I am here at my favorite coffee shop. Nothing like a good breakfast to start the day. We're moving fast on your journey. In our previous episode, we tackled one of the toughest financial decisions. Should you pay off debt or invest first? Now that you know where your money should go, it's time to talk about what you're actually buying. I remember when I first heard the terms stocks, bonds, and mutual funds. I honestly thought I needed a finance degree to get this. I over-researched, overthought, and stayed on the sidelines for years. That hesitation cost me time and growth. Today, we're killing that confusion once and for all. By the end of this episode, you'll know exactly what each piece does and how to combine them into a portfolio that actually works. If you learn something new, hit like, share this with a friend, and drop a comment. I love hearing your progress. Let's make these concepts simple and actionable. All right, before my pancakes get cold, let's dive in.
The big idea. Forget complicated charts. Investing really comes down to two simple actions. Owning, that's stocks, and lending, that's bonds. Everything else, like funds, is just an easier way to bundle those together. Block 1. Stocks, ownership equals growth. A stock is simple. It is a tiny piece of ownership in a company. When you buy one share of a company like Apple or Google, you are a part owner. This concept will change your mindset completely. Stop behaving like a customer and start thinking like an owner. This critical mindset change allows you to directly benefit from a company's success and build real wealth. How you make money. When the company does well, makes profits, and grows, the value of your ownership stake, the stock price, goes up. Sometimes, the company pays you a share of those profits, called dividends. The trade-off. Stocks offer the highest potential for long-term growth and are your best defense against inflation. However, they also carry the highest volatility, they go up and down a lot. Block 2. Bonds lending equals stability. If stocks are about owning, bonds are about lending. When you buy a bond, you are giving a loan to an entity, usually a government, a treasury bond, or a corporation, a corporate bond. Like in this example. First, you lend the money. We call this the principal. Second, the borrower pays you fixed interest every few months. That's your steady profit. Third, when the time is up, they pay you your entire principal back. You get your original money plus all the interest you earned. We call bonds the boring foundation of a winning strategy, and for good reason. They provide stability and reliability, especially when the stock market is volatile. How you make money. The borrower promises to pay you back the principal amount on a specific date, and in the meantime, they pay you fixed interest payments, coupon rate. The trade-off. Bonds offer much more stability and income than stocks, which is great for protecting your portfolio during downturns. However, they offer much lower potential for growth. They are the essential shock absorbers of your portfolio. So how do you manage the risk of Block 1 without the hassle of buying hundreds of individual investments? That's exactly why we use funds. Block 3. Funds, the basket equals simplicity and diversification. A fund is simply a basket that holds hundreds or thousands of different stocks or bonds. The types we care about most are ETFs, exchange-traded funds, and index funds, which are usually the lowest cost way to invest. The power of diversification. When you buy one share of an index fund, your single purchase instantly buys tiny pieces of hundreds of different companies. This is how you achieve instant diversification without any extra effort. If one stock in the basket drops, the others carry the weight, protecting your money. The secret to simplicity. To achieve a fully diversified, world-class portfolio, investors only need a small number of well-chosen funds, not hundreds of individual investments. Funds solve the problem of overwhelming choice. So, how do these three blocks fit into your wealth blueprint? Your portfolio is simply an equation. Stocks for growth plus bonds for stability equals your diversified portfolio. You use funds to make buying stocks and bonds simple, diversified, and cheap. The balance between stocks and bonds will determine your risk and reward. The perfect mix depends on your timeline and how well you sleep at night during a market drop. But the most important takeaway is this: you don't need to overthink it. Use low-cost funds to combine these two blocks, and you are already ahead of the game.
So here's the key takeaway from today. Investing is not a mystery. It's simply choosing between ownership, stocks, and lending, bonds, and bundling them for safety, funds. You now understand the basic building blocks of every single successful portfolio. Let me ask you, which block excites you most? Stocks, bonds, or funds, and why? Comment below. I'm looking forward to reading your perspective. The most successful investors don't just have a strategy, they have a wealth-building mindset. Before you go, know this: you don't need a huge sum of money to start investing. In the very next episode, we're talking about how to start investing with just $100. This is the crucial episode you need to watch. Like, subscribe, and share this with the friend who says investing is too complicated. Until then, keep learning, keep growing, and keep your money working for you. I'll see you in the next one.